What you are seeing on the screen right now is not a rally. It is a fundamental recalibration. For decades, no, for generations, this metal has played a dual role. It has been money in your hand and a miracle worker in the machine. But right now, those two identities are colliding in a way the financial world hasn't seen in over 40 years. The numbers flashing green are just a symptom. The cause is something deeper, more structural, and it's sending shockwaves from government vaults in the East to the trading desks of major banks in the West. And what those shockwaves are revealing could change the value of everything in your portfolio before this year's out. My name is Hostname, and you're watching Current CT. Today, we are going deep, not just on the what of silver's vertical move, but the why. We're going to look at the ratio that acts as a secret siren for smart money, the desperate measures being taken to control the uncontrollable, and what all of this tells us about the very bedrock of our modern system. This is a 30-minute journey to the center of the storm. So, let's start with the undeniable fact. Look at this chart. This line is leaving the realm of simple growth and entering the territory of geometric exponential ascent. In market language, we call this parabolic, but that's just a fancy word for running out of control. The price per ounce isn't just ticking up, it's making leaps that represent single-day gains larger than the entire price of the metal just a couple of decades ago. If you're watching this and feeling a sense of unreality, you're not wrong. The speed is disorienting, but speed is only dangerous if you don't understand the engine. And the engine here isn't fueled by hype alone, it's powered by two colossal, inescapable forces: critical need and failing trust. Let's break down the first force: need. Silver is not a speculative asset like a meme stock. It is a primal element, Ag on the periodic table, with physical properties that are, for many modern applications, irreplaceable. It is the most conductive metal on the planet. It is the most reflective. It is antibacterial. This isn't financial poetry, this is materials science. Every single one of these technologies, the very pillars of our promised green and digital future, guzzle silver. A solar panel cannot function without it. An electric vehicle uses multiples more than a conventional car. Your phone, your laptop, the server farm hosting this video, all depend on it. We have embarked on a global technological transition with an insatiable appetite for a material we are not discovering or producing in significantly greater quantities. This is a simple equation of physics, not finance. Demand curves are sloping up. Supply curves are struggling to bend. When that happens in any commodity, price is the only pressure valve. But this isn't oil or wheat. This is a metal that also happens to be historically money. And that's where the second force kicks in. Because when the money you use every day starts to feel ephemeral, the search for something anchor-like begins. This is the other half of silver's soul. For thousands of years, across civilizations that never met, silver and gold emerged, not by government decree, but by market choice, as the ultimate forms of liquid wealth. They were hard to find, impossible to destroy, and easily divisible. This monetary memory is encoded in our collective psyche. It lies dormant for generations during periods of stability. But what happens during periods of perceived instability? When central banks print currency on a scale that defies history? When national debts become abstract numbers we simply stop trying to comprehend? That dormant memory begins to stir. It whispers what is truly scarce, what cannot be printed with a keystroke. The price action you see is the point where these two rivers merge. The river of screaming industrial necessity and the river of deep-seated monetary anxiety. They're converging into a tidal wave. And the first place we see the tremors from this collision isn't necessarily in the dollar price. It's in an ancient metric that every precious metals investor watches like a hawk: the gold to silver ratio. This is our Act 2. If you take nothing else from this video,
Understand this ratio. It's breathtakingly simple. It tells you how many ounces of silver it takes to buy 1 single ounce of gold. For most of modern history, it's bounced around. In the last century, it's often been between 40 and 80. When the ratio is high, say 80 to 1, silver is considered cheap relative to gold. When it's low, silver is expensive. Now look at this. Watch this line. It is not declining, it is cratering. It is in free fall. We have blasted through level after level. As I record this, we are hovering in a zone we haven't seen in years. We are talking a ratio in the 40s. Think about what that means historically. For centuries, the natural geological ratio, how much silver is in the ground versus gold, has been estimated around 15 to 1. The monetary ratio throughout much of ancient history was often legally set around 12 to 1 or 15 to 1. The market is now violently compressing the modern bloated ratio back to that ancient equilibrium. This isn't a gentle correction. This is a violent reversion to a mean that is millennia old. And if it continues, the implications are not linear, they are explosive. Let's play a thought experiment, rooted in that historical pull. If the primary driver was only monetary anxiety, gold and silver would likely rise in lockstep, preserving their ratio. But they're not. Silver is massively outperforming. That tells us the industrial demand engine is the accelerator. It is the extra thrust propelling silver faster, thus crushing the ratio. So, who feels this tremor most acutely? The entities with massive opposing bets on the table. This brings us to Act 3, the dominoes fall. And the first domino isn't in Wall Street, it's in Shanghai. The Chinese market for years has often priced physical silver at a premium to the West. It's a signal of intense local demand. But what we're seeing now is different. Trading exchanges exist to provide orderly markets. Their worst nightmare is a runaway, illiquid, disorderly market. So, when a price moves so fast it threatens the very mechanics of trading, they intervene. They widen the daily allowed price movement bands. They restrict how many new contract speculators can open. This is what we're seeing now. These aren't measures to kill a rally. They are emergency brakes being applied to a train gaining too much speed on a downhill slope. And it tells you one thing for certain: the momentum is not artificial. It is overwhelming. Think about it. Who imposes trading restrictions? Authorities do when they feel a market is moving beyond the realm of rational participation into something volatile and dangerous. They did it with nickel. They've done it with other commodities. Now they're doing it with silver. The last time we saw Western exchanges take similar desperate measures was during the legendary Hunt Brothers squeeze in 1980. History may not repeat, but it often rhymes. And what about the West? The tremors are here too. Reports surface, sometimes confirmed, sometimes denied, of major banks and bullion dealers temporarily halting sales of their silver products due to overwhelming demand, the notice often reads, or for system maintenance. But read between the lines. A bank or dealer is a shop. What shop voluntarily closes its doors when customers are lined up around the block waving cash, desperate to buy? Only one that is afraid the price of its inventory is about to leapfrog the price it just promised to sell at. It's a fear of instant catastrophic loss. It's a signal of logistical and financial stress in the supply chain. This is the sound of the system groaning under a pressure it wasn't designed for. And into this noise steps a familiar voice from the financial media chorus. Now we arrive at a fascinating psychological indicator. There's a well-known, almost meme-worthy phenomenon in certain investing circles, the inverse Kramer effect. The idea is that the very public, very emphatic recommendations of a certain celebrity stock picker have become such a reliable contrary indicator that doing the opposite is a viable strategy. So when this personality goes on social media and specifically derides the silver rally, calling it ridiculous, and proclaims they are not a silver bug, a specific segment of the market doesn't hear analysis, they hear a foghorn. When consensus opinion becomes a contrary signal, the trend is your friend. This isn't about the individual. It's about what they represent. The entrenched mainstream finance for entertainment viewpoint. That viewpoint is deeply invested in the current system of stocks, bonds, and digital dollars. A rip-roaring ancient metals bull market is an existential threat to that narrative, so it must be dismissed, mocked, or ignored. but you cannot mock away a physical shortage. You cannot ignore a chart going vertical. The louder the dismissal, the more it convinces the skeptics that the move is real, powerful, and threatening to the status quo. This brings us to the final and most speculative act. What comes next? We've laid the groundwork of demand. We've seen the market mechanics strain. We've observed these social signals. Where does the path lead? Let's be clear. Predicting a precise price point is a fool's errand. Anyone giving you a definitive number is selling you something. Our job isn't fortune telling, it's framework building. So let's talk in frameworks. Framework 1, the catch-up. If this is primarily a repricing of silver to reflect its industrial criticality and its historical monetary relationship to gold, then simple ratios give us a spectrum. With gold breaking to new all-time highs in certain currencies, if the gold-to-silver ratio were to simply return to its long-term modern average, not even its ancient one, we're talking about a significant revaluation from current levels. Framework 2, the scarcity premium. This is where it leaves the realm of finance and enters the realm of resource economics. What if annual industrial demand consistently surpasses new supply from mines and recycling? Then we are not talking about an investment asset.
We're talking about a consumable commodity that is being permanently drawn out of above-ground stockpiles. Price ceases to be a mere trading variable and becomes a rationing mechanism. It allocates the remaining metal only to the highest priority, highest margin uses. In this scenario, volatility becomes the norm, and spikes become breathtaking. Framework 3, the monetary reset. This is the outer bound systemic scenario. It's not a prediction, but a possibility we must acknowledge to be intellectually complete. If confidence in fiat currencies continues to erode on a global scale, the search for a neutral, non-sovereign, tangible backing asset intensifies. Central banks who have been net buyers of gold for over a decade start to look at silver's twin monetary history. What if, in a world of competing blocks, silver reemerges not as a pet rock for investors, but as a strategic monetary metal for nations? The demand shot from that would make every chart we've seen so far look like a flat line. The common thread through all these frameworks? Upward pressure. Different magnitudes, different velocities, but the direction is consistent. The conditions for a bear market in silver, abundant new supply, declining industrial use, and unwavering faith in paper money are conspicuously absent. So what does this mean for you right now, today? First, it means understanding. You are no longer just watching a ticker. You are witnessing a slow-motion collision between our digital future and our tangible past. This knowledge is your anchor. Second, it means context. If you own physical silver, understand its role. It's not a get-rich-quick stock. It's a form of savings outside the banking system. It's a hedge against systemic fragility. It's a call option on a future where matter still matters. The volatility is a feature, not a bug. It's the market searching for a price in an uncertain world. Third, it means clarity of purpose. Why are you interested? Is it for short-term trading? That's a dangerous game with an asset that's volatile. Is it for long-term preservation? That requires a different mindset, one of accumulation and patience, ignoring the daily noise for the multi-year signal. In a world of digital promises, physical possession is the ultimate sovereignty. Finally, it means vigilance. Watch the ratio, watch for more exchange interventions, watch the narratives in the mainstream financial press. The story will evolve, and the next chapters will be written by how governments, corporations, and millions of individuals react to this new reality. We stand at an inflection point not just for a metal, but for an idea. The idea of what holds value when complexity fails. The currency are changing. They are blowing away the dust from old ledgers and ancient truths. Silver's surge is not an anomaly. It is a symptom of a world trying to bridge what it needs to build with what it trusts to hold. This has been a deep dive into the heart of that storm. If this framework, this context has provided value for you, if it's helped make sense of the chaos, then do me this favor. Like this video. It signals to the algorithm that long-form thoughtful analysis has a place here on YouTube. It helps this channel, Currency Tea, grow and continue to provide this level of depth. And I am deeply curious. Forget the price for a second. In your view,
What single force, the green energy transition, monetary anxiety, geopolitical strategy, or something else entirely, is the primary engine for this move? Let's have a nuanced discussion. Drop your perspective in the comments below. The 21st century's most critical conflict may be fought not over oil, but over periodic table elements. Thank you for spending this time with me, for seeing beyond the headline, for thinking deeper. I'm host Naeem, and you've been watching Currency Tea. Until next time, stay thoughtful.